Dear students, we'll solve one more problem on assessment of companies applying MAT. This is video number 9. Okay, problem of Excel Limited is given here. It's a domestic company and it's given for the year ending 31st March 2020. So, profit and loss account is given, followed by that some adjustments are given. Let's look at the adjustments. An outstanding liability relating to GST for 2018-19 paid during the year 2019-20 is 50,000, which was not charged to profit and loss account. Above given profit and loss account. That means it is deductible on payment basis. So it is not included in this profit and loss account. It's relating to last year. So it is allowed as deduction under payment basis. So 50,000 is deductible while computing business income. Okay, next brought forward loss as per books of account 60,000, while brought forward depreciation as per books of account is 80,000. So here what you have to do is you have to compare the two, 60,000 or 80,000, whichever is less. So brought forward business loss as per books of account and brought forward depreciation as per books of account. Of that two, whichever is less, that is deductible from net profit while computing book profit. Let me repeat. If the information is given regarding the books of account, then that is deductible while computing book profit from the net profit. So net profit is the starting point. So under deductions, you have to take unabsorbed business loss brought forward or unabsorbed depreciation brought forward as per the books of account. Of the two, least one is deductible, that is 60,000 is deductible from book profit. Then brought forward unabsorbed depreciation for like 60,000. This is deductible from any head, maybe from business loss or any other head, while computing book profit. Okay, now, that has nothing to do with while computing book profit. Brought forward unabsorbed depreciation here, it means it is for tax purposes, because as per books of account is given in the previous point. So this is as per yes, for accounting purpose it is given. So that is deductible from business income. The next brought forward loss under the head capital gain. So if you look at the credit side of profit and loss account, you find here long-term capital gain of rupees 5,70,000. So from that, this loss can be set off against this particular income. Okay, right. Compute the total income and tax liability for the assessment year 2021 applying MAT. So what are the items to be taken as disallowed while computing business income, let us say. Okay, first two, these are allowed. Proposed dividend, this is not allowed. So this will be added back to net profit while computing book profit. So also provision for unascertained liabilities, transfer to general reserve, income tax. These are the items to be added while computing the business income. Similarly, you have to deduct from the credit side long-term capital gain. This is to be deducted because that is not relating to business income hand. Similarly, amount withdrawn from general reserve should be deducted. Whereas sale of goods manufactured by the company and sale of other goods proceeds from these two, that is part of business income, that is not to be deducted. Then again, these 50,000 are to be deducted. Okay, that's what you have to do. Just to go to the solution now. Computation of total income. Okay. Disallowed items. I'm sorry, this should have been business income, not total income. Total income is given subsequently. This is business income. Computation of business income and subject correction. Computation of business income for the assessment year 2020-21. Net profit as per profit and loss account 8,85,000. You can note here. So net profit is given as per profit and loss account is 8,85,000. So proposed dividend should be added back. Provision for unascertained liabilities, general reserve, and income tax paid. These are the items to be added to net profit. This is very simple because difficult problems you already solved and you are familiar with the treatment of these items. So 9,35,000. Totally that comes to 18,20,000. Now less admissible expenses. Only one item is there, that is GST paid of last year but paid during the year. So on payment basis that is allowed to be deducted 50,000. So 17,70,000. Then on the credit side of the profit and loss account, you find these two items which are not allowed. Rather, they have to be taken separately. So capital gain, long-term capital gain 5,70,000 and amount withdrawn from general reserve 5,90,000 is deducted from 17,70,000. So you get 11,80,000. And you find here unabsorbed depreciation. So unabsorbed depreciation 4,60,000 is there. So this should be deducted from, yes, business income. So 4,60,000 is deducted from 11,80,000. So after set off of unabsorbed depreciation brought forward, what you get here in the form of business income is 7,20,000. Now we'll proceed to computation of total income. Previous one is business income. Let me make it very clear. Okay, so that is house property income is nil. Business income we have calculated 7,20,000. Then capital gain, long-term capital gain 5,70,000. And you have got here one item brought forward loss under the head capital gains. This should be set up only against long-term capital gain. Therefore, that is being deducted here. 3,50,000. It has been set off. So 2,20,000 is the residue. Other income, you don't have any other income. So 9,40,000 is the gross total income. So deductions under section 80 in this problem, nothing is there. So total income is 9,40,000. Alright, now we'll move to computation of book profit. So if you take here the debit side, what is to be added back is proposed dividend, provision for unascertained liabilities, general reserve, income tax. That is all. And on the credit side, you have to deduct amount withdrawn from general reserve. Long-term capital gain is not being deducted. It should be part of book profit. So, proposed dividend should be added. Provision for unascertained liability should be added. General reserve, income tax paid. So, put together 9,95,000, 35,000. So, after addition, 8,20,000. Therefore, amount withdrawn from general is 20,000. And one more item, brought forward business loss or brought forward unabsorbed depreciation for accounting purpose. Of the two, whichever is less, that is deductible from net profit while calculating book profit. So here 60,000 or 80,000. 60,000 is a lesser one. So 60,000 is taken under deduction. So total deductions are 80,000. As a result, book profit is 17,40,000. Next, now tax liability. There are two things, you have to compute two things, tax on total income and tax on book profit. The tax liability is tax on total income or tax on book profit, whichever is higher. Okay, so here total income is 9,40,000. You find here 9,40,000. Yes. Of that, 2,20,000 is long-term capital gain after set off of a brought forward capital loss. So on 2,20,000, straight away at the rate of 20%, it is a special rate applicable. Then on the balance of total income, okay, out of 9,40,000, if you deduct 2,20,000, what remains is 7,20,000. On that, you have to apply 30%. It is a domestic company. That comes to 2,16,000. Total taxes 2,60,000. Surcharge is not applicable because the total income does not exceed 1 crore here. Then next, total remains the same. On that you have to add health and education cess at the rate of 4%. So that comes to 10,400. So tax on total income is 2,70,400. And tax on book profit you have to calculate. Book profit is 17,40,000. On that straight away 15%, that comes to 2,61,000. Surcharge is not applicable here, as I have told you. total income does not exceed 1 crore. So it remains the same. Health and education cess at the rate of 4%, that comes to 10,440. As a result, tax on book profit is 2,71,440. What is the tax liability? Tax liability is equal to, I already told you, tax on total income or tax on book profit, whichever is higher. Here, tax on total income is 2,70,400. Tax on book profit is 2,71,440. So of these two, second one is higher one, that is tax on book profit. So MAT applies here. Minimum alternate tax is applicable. So since the tax on book profit is more than the total tax on book profit, a book profit is taken as total income and the tax is calculated, and that is the tax liability. So 2,71,440 is the tax liability. And MAT credit, see, 2,71,440 tax on book profit, it is also called MAT, minus tax on total income, that is 2,70,400. The difference is 1,040. This is the MAT credit under section 115 JEE. So this is available for set off when the tax on total income is more than tax on book profit. In other words, where MAT is not applicable. Okay, that's about this problem. Thank you for listening.